Hello and welcome to today's class. Today we are going to deal with the topic depreciation. Now, what is depreciation? Depreciation is the fall in the value of the asset over a period of time due to wear and tear or the passage of time. You must be knowing that whenever we purchase a car from the showroom and then when we go to sell it like about 3 or 4 years later on, we won't be able to sell it at the price that we had bought it at. It will be a reduced value. So that reduction in value is depreciation. Depreciation is a term which is used only for fixed assets, fixed tangible assets. And this is an expense which is mandatory. There is no option for this. And depreciation is charged gradually over the years and cost is allocated. So now what are some causes of depreciation? Like I said, one is the wear and tear, passage of time, obsolescence, or if any accident has happened. Usually the cost will be gradually charged over a course of time. Not everything at once, unless there has been an accident. Now, these are some terms on your screen that are used in context of depreciation. So first we have depreciation, which is charged on fixed assets. Then we have depletion. What does depletion mean? Now, depletion is used in context of a natural resource. For example, you have a mine, a gold mine, or you're digging for oil. Since that is a natural resource and its quantity is limited or fixed, the more you keep extracting, the more it will get depleted, right? So depletion is used in that context. The next term that we have is obsolescence. Obsolescence means outdated in other terms or out of fashion. So this mostly happens, you can see this with softwares. Some softwares which were used in the 2000s are no longer being used now. Those softwares have become obsolete, out of date. They are no longer in use. And next term that we have is amortization. Amortization is nothing but depreciation, but it is charged on intangible assets. That's the only difference between depreciation and amortization. Amortization refers to writing off a proportionate value of the intangible asset like goodwill or copyrights or patents. It is similar to depreciation. The only difference is that it is charged on intangible asset. Now, what is this accounting concept of depreciation? Like I said, depreciation is a mandatory cost. It is not optional. It has to be charged. Depreciation has to be charged. And depreciation will be charged over the cost of the fixed asset over its useful life. So, the entire cost of the fixed asset will not be expensed out in one accounting period, but it will be divided over the coming accounting periods. Now, we will see two methods by which we can calculate the amount of depreciation to be charged on the fixed asset. The most simplest method of charging depreciation is the straight line method. The terms involved in the straight line method are number one, the original cost of the asset. Now, the original cost of the asset involves its purchase price and plus all those other costs which are incurred in making the asset in a usable manner, bringing it to a ready to use manner. Okay, that is the original cost of the asset. Next we have scrap value. Scrap value is the residual value that will remain at the end of the life of the asset. Now that asset is no longer in use and its useful period is over. So what value will I get after when it is no longer in use? So for example, I have an air conditioner, an AC in my house. I have used this AC for the past 25 years. Now, after 25 years, if I want to go and sell it out in the market or give it out, it's no longer working. My AC is no longer working and I want to dispose of it. So I will scrap it. How much value will I get? That particular value that I will get when I go to dispose of my AC after I have used it for 25 years is my scrap value. FYI, it's like about 3,000 or 4,000 rupees in Indian market. Now the next term that we have is the useful or the economic life of the asset. we are seeing now that we can't use a smartphone for more than 6 years. Maximum 5 to 6 years we're able to use we're able to use a smartphone. So that 5 years I can say is the useful life of my asset, of my smartphone. Useful life is nothing but the number of years that that particular asset will be of service to me. In the last example, in the AC example, 25 years was the useful life. Now in the smartphone example, it is 5 years. So similarly, there can be many different assets. So for like a car or a truck, the useful life would be about 10 to 15 years. Now, now we will use this data to calculate our depreciation. So the formula for depreciation by straight line method is the original cost of the asset minus its scrap value divided by the useful life of the asset. Okay? And in straight line method, the same amount of depreciation will be charged every accounting period throughout the useful life of the asset. So for instance, if my asset value is 1 lakh and I'm charging 10% depreciation, so 10% of 1 lakh is 10,000 rupees. That means my depreciation is 10,000 and my net value will be 90,000 at the end of year 1. Then at the end of year 2, I will again charge 10,000 rupees only as my depreciation. This is straight line method. In straight line method, every year the same amount of depreciation is charged. Okay, so I will charge rupees 10,000 even in year 2. I'll deduct it from my the net value of my asset, and then at the end of year 2 I will get 80,000. In year 3, from 80,000 I will subtract 10,000, then I will get 70,000. Then in year 4, from 70,000 I will deduct my depreciation 10,000, then I'll get net value of 60,000. As you can see, in all these years, as the years pass by, depreciation is still 10,000. So every year the cost of my asset is being distributed over its useful life by 10%. So that means at the end of 10th year, the value of my asset will be 0. This is the straight line method. This is one way of calculating. You will either be given a percentage or you will be given this data from which you will have to calculate the depreciation amount. You will be given the cost of the asset, then you will be given its scrap value as well as its useful life. The minute you see these terms in your question, you need to know that this is straight line method. They are asking you to calculate depreciation as per straight line method. So you will use this formula, or if they give you a percentage, then you will calculate depreciation as a percentage of the asset value. Now the next method of calculating depreciation is the written down method. What is the written down method? So like we saw in the straight line method, every year depreciation, when it is charged as a percentage, the same amount of depreciation is being charged every year in straight line method. But in written down method, the same amount won't be charged every month, every year. The same amount won't be charged every accounting year. It won't be. So for example, if my depreciation is charged at 10% and my asset value is 1 lakh when I purchased it, in year 1, 10% of 1 lakh is 10,000, then I will get 90,000. In year 2, on 90,000, I will calculate 10% as depreciation. I won't write 10,000 again. On my net value, I will calculate depreciation. Every accounting period, on the net value of my asset only, I will calculate depreciation, not on the original amount. So in this method, the amount of my depreciation will keep reducing every year, and it will not become 0 at the end of the 10th year, as you can see the value of the asset. So in year 1, 90,000, then in year 2 on 90,000 I charged 10% depreciation, which gave me 9,000. So the net value of my asset was then 81,000. Then in year 3 on 81,000 I charged 10%, which was 8,100, and then the net value was 72,900. So on and so forth. Then in year number 10, my value is about 38,000. On this 38,000, I have charged a 10% depreciation, which is like 3,800, and then I have come with the net value. So these are the two methods of calculating the depreciation amount. This written down method is also called diminishing balance method. Now that we have seen the different ways of calculating depreciation, let us see the two ways in which we can record depreciation in our accounting books, in our accounts. So in the first method, we directly charge depreciation to the asset. In this method, depreciation is directly deducted from the asset value, and my journal entry would be depreciation account debit to asset account, being the depreciation charged on an asset. And this depreciation is then transferred into profit and loss account. So profit and loss account will be debited because depreciation in nature is an expense. Okay, that is why you are going to debit your profit and loss account, and this is also in a way a closing entry. So your depreciation account you will close. That is the reason depreciation account will be credited. So your first journal entry will be depreciation account debit, asset account debit to depreciation account, then profit and loss account debit to depreciation. So you're transferring the depreciation to your profit and loss account and closing the depreciation account, and your asset account will be reduced by the amount of depreciation charged. So in your balance sheet, it will be shown like this. You will have your asset, the value of your asset will be written, and from the asset value only you will deduct depreciation in the balance sheet. And in your asset account, you will record on the credit side depreciation. Let's see the second method. Now the second method is when provision for depreciation is maintained. So what is a provision? Provisions are usually amounts which are set aside to meet an expected loss. Okay, so this amount is removed from your profit and loss account to meet a known loss. Now it is 50-50. This can happen, this cannot happen. So why do we maintain a provision for depreciation? Depreciation we know is going to happen. That is why we are maintaining it. This is just another way of representing how depreciation is charged in the accounts. So in this case, instead of charging depreciation to my asset, I will charge depreciation to the provision for depreciation account. My asset account won't be touched over here. Okay, my asset account will not be touched. Only in the balance sheet from my asset, the provision amount will be deducted. But the original cost of my asset will remain as it is unless I sell it off. Okay, but that's later. So instead of expensing depreciation to my asset account, I will expense it off to my provision for depreciation account. And then again I'll transfer depreciation to profit and loss account to close off my depreciation. Because depreciation is my revenue expense, I'll pass out the closing entry profit and loss account debit to provision account. Now how will this be shown in my final accounts? In my balance sheet, the original cost of my asset will be shown, and from there I will deduct the provision for depreciation. Okay, and in my asset account, like you can see, my asset account is maintained. There is no depreciation charged in my asset account. But in my provision for depreciation, which has a credit balance, like see, by balance brought down, it will have an opening credit balance. Depreciation will be charged. In the first method, we were directly charging depreciation to our asset account. But in this method, in the provision method, we are charging depreciation to the provision for depreciation account. That is the only difference between the two. The accounting treatment will be different, and the way we show in the final accounts will be different. So let's do a quick recap. We studied what depreciation was, what are its causes, what are the related terms, what are the different methods to calculate the depreciation amount, and the methods to represent it in the final accounts. Depreciation is the fall in value of the asset due to the passage of time. There are two methods of calculating depreciation. One is your straight line method and one is your written down value method. In the straight line method, we are charging the same amount of depreciation every accounting period. Whereas in the written down value method, we are charging depreciation on the net value of the asset every year. So every year a diminished balance is calculated. That is why it's also called diminishing balance method. And in our accounts, we show it in two ways. One is when depreciation is charged directly to my asset. So my journal entries are depreciation to asset, and then the closing entry profit and loss account debit to depreciation. And in the balance sheet, we are showing it in a particular way. And in the second method, when provision for depreciation is maintained, we are charging depreciation to our provision account instead of our asset account, and the accounting treatment also differs. Now in the next video, we will solve a question which shows how to record depreciation in both these methods. So that's all for this video. If you have any doubts, please feel free to reach out to me in the comment section. See you in the next video.